The answer depends on two factors. One is based on inflation. Yields reflect in part long-term inflation expectations, and the other one is based on risk appetite. So on the first approach, inflation swaps, which are one of the ways to measure long-term inflation expectations, have peaked in the spring. That is a sign that the market is attributing more confidence to the view that central banks will eventually get inflation under control. So that's the aspect that suggests that we have seen the peak in yields because bonds don't need to compensate for much inflation risk. The other approach is to look at investor risk appetite. And there the picture is more mixed. There's many proxies for this investor risk appetite, but one I'd like to use is implied volatility in the options market. That implied volatility keeps going up. And what this reflects is that investors are expecting a lot of price movements in bonds, and therefore that they're not very keen to invest in bond at the moment. So it's a nuanced picture. The way I look at this is that we think that the peak is in for 10-year US Treasury yields, around 3.5%. The reason why we're more confident in the US is because the Fed has already taken pretty aggressive tightening steps. In Europe, on the other hand, in the Eurozone, so base rates there are still negative, and therefore investors and markets are less confident. Therefore, as much as it's probable that the peak in US yields is there, around 3.5%, it's probably not the case for bond. Probably that over the coming few weeks, we might peak to perhaps even 2% before we eventually decline into the end of the year as recession fears boil over in the Eurozone. What this means is that the spread between the two will narrow.